Okay, good afternoon, everybody, and welcome to our Think Learning webinar today, 3 stocks with dividends and growth. My name is Capolingua. I'm the market analyst over here at Think Markets, and it's a pleasure to be with you today as we try to do the impossible, find stocks that have both dividends and growth. We'll talk about that and more after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number. That's very important. Of course, to know that the shares are yours. They're not held in trust somewhere else with a bunch of other people's shares. They are your shares. And of course, no hidden platform fees and unlimited phone support. You get to speak to a real person here in Australia. 4 fantastic reasons to make sure your next ASX share trade is with us. The agenda for today is to, as I said, try and find those stocks that have dividends and growth. Certainly very relevant right now. It's relevant all the time, but even more relevant right now, if that's the right way to say it, because we are seeing a major rotation in the market. We're seeing the market try and reconcile these higher rates, and therefore whether growth stocks are still worth owning. Those are stocks that funnel every cent they get, whether that be from selling their wares or from investors like you and I, into growing their business. And because they are using all of their capital to grow their business, they don't pay dividends. Typically, they don't pay dividends, or if they do, because they're a more established technology company, for example, or growth company, those dividends are very low. So often it's a trade-off. Do we have growth or do we have dividends? Typically what we find with companies that pay high dividends, they are well-established businesses. They are in a phase where growth is hard to find, and they're cash cows. There's lots of cash coming into the business, and with few or limited growth opportunities, they tend to give that capital, those profits, back to shareholders, okay, in the form of dividends, and therefore they have higher yields. So often there is a trade-off in the markets, and we're seeing this rotation now away from growth stocks back to more value. Typically, they're high dividend paying oriented stocks. So today we'll try and do the impossible, as I said, find stocks that have a good balance of each. And I think that's how you protect your portfolio through these uncertain times, is having stocks that are well balanced themselves, much like also having a well balanced portfolio. Okay, so we'll talk a little bit about more about our selection process. We'll talk about the 3 stocks I've got for you today. They're on screen: Empired, ticker code EPD; IVE Group, ticker code IGL, and then an ETF. I thought I'll do something a little bit different today and throw in an ETF, because you get a bunch of stocks in an ETF. And in this case, we've got 98 of the highest, most stable dividend payers from all over the world in that SPDR S&P Global Dividend Fund, ticker code WDIV. And then I've got a few honourable mentions as well, and they could have definitely have made the list. In fact, some of them may have been on the top 3, if not for the fact that I've covered them in webinars already. Okay, so let's talk about our selection process, and first and foremost, how we look at things in terms of their financials and their valuation. And it's important to do the first bit first, and that is find growth at a reasonable price. So yes, you might be an income investor. You might want a very high yield because you're in that phase of your investing career or journey where you're living off the income from your portfolio, and therefore high dividends are really important and capital growth is less important to you. But I still think the safest thing you can do to withstand all market conditions is still to find stocks that are growing their business. So question mark number 1, is the business growing? Is the business able to fund its growth organically? So the cash that's coming in, they can use that to fund. Obviously, that cash can also be paid back to shareholders as dividends. And is there value in the company right now? So yes, there's growth, but is the stock still trading at value? And often those two things are disconnected, as we've seen in the markets at the moment. Some of those growth stocks don't necessarily have great value within them. So trying to find a mix of growth and value, as well as growth and income. And then, because the subject today is, of course, about income, does the business have a high? And I've used a 5% sort of benchmark there. % per annum dividend yield. Is it sustainable and growing? There's no point having a stock that's got a 10% yield this year if the earnings are shrinking, if the earnings are going to halve over the next 12 months, and therefore their dividend is going to halve over the next 12 months. So that's 10% yield. It's not 10%, it's really more like 5%. So is the dividend yield sustainable? Is it going to grow? And is it fully franked? That's less of a concern for me. Typically, if you've got stocks that are paying great dividends and got great growth prospects, and that those that growth is coming from overseas, you're unlikely to have franked dividends simply because they're potentially paying tax elsewhere, or it's overseas earnings. So that's often less important, but it's a bonus if we can get it. Okay, then the next thing we like to look at, and this is always the key factor for me, is the market seeing what we see. So we want a nice chart as well. We want to see the price in a short-term uptrend to tell us that those shorter-term investors and traders are buying the stock, certainly more than they're selling it. And are we in a long-term uptrend? So those big positional institutional investors are also buying the stock as well. And then hopefully within those two, we might see a little bit of a pullback or getting close to a breakout. Is the price near an opportune entry point? Welcome to everybody who's just joined us since the start. Of course, this session is being recorded and I'll upload it to the website. If you did miss the first bit, you can always jump on and catch it there. Okay, so the first one we're looking at is Empire. This is an information technology company. So to start off, it's one of those high-growing tech stocks. The bonus is we've also got the yield. So if you're looking for technology exposure with a yield, this is the way to go. So these guys they're pretty much, it's a broad range of IT services. Probably the key one is that cloud applications, including the Microsoft Azure suite of web apps, but it's all about streamlining your business. It's about optimizing your business. It's about augmenting human processes. So if you've got a human being doing the same thing over and over and over again each day, maybe there's a computer that can do that process for them and do it faster and more accurately. It doesn't mean you don't need the human necessarily. Sometimes you don't, and that might be good for your business too, because you can cut costs. But sometimes it's just supporting that human in what they do. So these guys are big on artificial intelligence. It's certainly a growing area of the technology sector. And then we've got automation of other business processes, including accounts payable, customer service, so virtual agents. I find these more frustrating than beneficial, where you've probably done this. You've gone into a company's website, you've gone into the little chat window and trying to get your problem solved, and there's actually a computer on the other end of it using artificial intelligence to try and answer your questions as best as it can. They also do business communications, security, work from home, work remotely, network cloud services. These are all keywords in the technology space at the moment, especially given what's happened with COVID. There's going to be more of a shift towards that sort of work. And then over the top of that is the data collection. So monitoring how all of these processes impact your business, and then helping you using that data to optimize your business even further. So a really neat little business that they've going on at the moment. They're mainly Australia and New Zealand at this point, but they are looking to scale into the USA. What I like about the business from just the way they earn their money, they've got many long-term contracts. They've got a lot of as I said, long-term contracts, long-term clients, therefore, with high repeat revenue. So revenue that just comes in the door. They don't have to do too much to keep that going. Obviously, provide a great service, but that's a great base then to reinvest in the business and grow the business further. It's a software as a service. A lot of it is software as a service. So as soon as you see that capital SaaS, straight away you're thinking high margins. Okay, so very good, easy money if you can get it, and it is a scalable platform, as most technology platforms tend to be. This is where and how they earn their money. It's obviously mainly Australia and New Zealand at the moment, but they are looking to expand into the US, so that could be a major growth area for them. Services versus operations, and then where we talked about the various components of the business and where the money's coming from. At the moment, I did say that most of it is coming from those business web applications, so reselling those Microsoft applications. This is an interesting one for me as to where, in terms of the industries that they're earning their money. So if we want to think about earnings growth going forward, we want to think about, well, are the industries where they're earning their money growing? And the big one there is energy and natural resources, and we know we are in a phase right now of an upturn in that sector. I'm based over here in WA at the moment, and I can tell you that anecdotally from conversations around various barbecues that that sector is absolutely going gangbusters at the moment. Property over here is as hot as it has ever been, I think, even since the 2007 boom, and we are starting to feel that way over here. So the fact they've got a big exposure over here, and geographically WA is but state-based is where they earn their most money. They've just picked up a big contract over here with Western Power as well. So you see government, semi-government organisations is the next biggest thing there, and that's really stability. And you can go down the list. They're typically those industries are growing, and it's a company that is well leveraged to the recovery in the Australian economy as well, which I've put down here. Given what's going on, particularly WA and resources. In terms of their recent half-yearly results, a very solid performance given what's going on with COVID. So many great companies saw their businesses adversely impacted by COVID. These guys still managed to grow sales revenue, and because, like many businesses, they have really focused on their costs and been really sensible with their investments, that only small increase in revenue accounted to a very, very large increase in EBITDA. And I'll use these acronyms as we go through, but that stands for earnings before interest, tax, depreciation, and amortization. And FCF stands for free cash flow, and this is one of the key components of the business. I've done a webinar in the past on how to value a business. We talk about cash flow in that one, so get onto the webinars, not the webinars page, the market use page, and then you can use the filters to search for our webinars, and you can review how we value companies and how important that free cash flow is. So to see that up 60% is incredibly impressive. So they also had some asset sales during the period to pay down debt, so a significant reduction in their debt, their maiden dividend. So this is a really neat one, because if you went back 12 months, this wouldn't have been on the list. It didn't pay dividend, but the dividends are here. The company feels confident enough in the stability of their earnings and the growth they've got going at the moment to pay dividends, and that is so impressive for me. And we should be expecting somewhere between sort of 3 and 4 cents of dividends this year. When your share price is about 75 cents, that tells you you're going to have a pretty good yield on it. New contract wins during the last half. We talked about that Western Power deal. That's going to start contributing in the second half, and that is a big deal for them. Margin expansion and flat expenses that help that EBITDA performance, and we know that those software as a service businesses do have great margins, and these margins are getting better. The company has given us guidance, which is unusual for companies at the moment. They've usually been quite coy on telling us how they're going to go, and they have forecast that they will exceed last year's EBITDA by some 13 million, or at least 13 million. So they haven't given us a top end of the range, just said, look, we're going to be at least about 32 from here on in, and that is a big beat on last year. And we're expecting a second half dividend, so that is the other reason why we are going to be here, and of course why this one's on the list today, and we talked about that last point there. In terms of some of the other financials, and I'll just whiz through these, really, rather than saying, okay, well, the revenue in FY17 was about 160 million, that's not important. We're just looking for trends here, so we want to see as much bottom left as top right as we can. Now, because of COVID, there are going to be dips, so there was a little dip there in revenue, of course. But that's starting to pick up. We know that's backing up. We know revenue growth is coming in FY21 through that half-yearly report. Thanks for rejoining, everybody. If you are catching this in the recording, there was a major technical malfunction at my end. It wasn't your end. Everything went blank. I did, and then the computer wouldn't restart. I do have an alternative backup power source and battery, and I've changed them over. Unfortunately, now everything's going. So apologies for that. We'll pick up from where we left off. And where we did leave off was this discussion about the financials on screen for Empire, this very interesting information technology company we've been talking about. And we said that on any chart of revenue and resulting profits, we want to see those heading up. We did say that there could be blips due to COVID, which is not surprising given those circumstances. And then what we're paying for those earnings in the price to earnings ratio, we'd prefer to see that going down. And I've actually made a bit of a typo here. I should have put the dividend yield in this one, which you'll see on this one would actually be no dividends here, and then we're starting to see it head up. So apologies for that. There's a bit of a typo here. It should be the dividend yield. In terms of how this company compares to the other stocks in the market, and here I like to focus on the All Ordinaries Index, which has the top 500 or so companies in the index. In terms of its enterprise value to revenue, it is in the top 10% of companies on the All Ords. Now, if you go outside the All Ords, you get very few companies that are earning money anyway, so we can use it as a proxy for the biggest and the best companies on the market. And going down the list, you can see some of the highlights there. The dividend yield is better than 82% of companies out there. Price to sales, price to cash flow. We talked about the very strong cash flows within the business. Very strong indeed. And when you average all of those things out, you get 70%, which is putting it in the top 17% of companies. Now, you might ask straight away, well, Carl, why don't you show me one that's at 98% or 99%? Well, the subject today is finding dividends and growth, and you might find that the top companies don't necessarily exhibit all of those factors that we're looking at, and or the final factor of the chart in the right spot as well. Don't forget fundamentals. Sometimes slow to react potentially to what the chart is seeing as well. So it is a very strong rating, make no mistake, that 83% on Empire. In terms of its valuation, this is just summarising what we saw on the previous screen, but that's our average rank there, which is in the top 17% of companies on the ASX, and dividend yield, note this one is unfranked at this stage. But as the company grows its franking credits, no doubt that will change. In terms of the chart, and again, this is that factor tying it all together, the dividends, the growth, and the nice chart. And we're looking at the short-term uptrend, which is the light green zone, and the dark green zone is the long-term uptrend. And as I said, I like to see those both heading up, and we're certainly seeing that at the moment. We often see that the short-term uptrend is a trampolining point. Not all the time. Sometimes we can get a little bit below it. Sometimes if we do get below it, it's a warning sign that the trend is potentially changing. But we are seeing a pullback into that trampoline zone now. So that would present to me that quote-unquote opportune time to buy. We're not paying this high price up here, which was after those half-yearly results, which were very well received by the market. Market's settling down a little bit. We're getting that pullback. Otherwise, price action with the high peaks and high troughs looks very, very good as well. So 3 ticks for me in terms of its yield, its reasonable valuation, strong, broader financial performance, and then the chart. The second stock we're going to discuss today is IVE. Ticker code on that one is IGL. It's in the telecommunications sector. It is a marketing company, so end-to-end marketing services provider. And straight away, when you think marketing, you've got to think, well, bad year because of COVID, because obviously companies, when they were going to ground and really bunkering down, trying to survive through COVID, they're not thinking about increasing their marketing budgets, are they? So marketing companies typically would struggle through that period, but then the flip side of that is coming out of COVID with the economy not taking too much of a hit, certainly here compared to the rest of the world, and with all that stimulus that we're throwing at this economy, low interest rates as well, we're going to see a major bounce back in economic growth, and that means greater spending on exactly what these guys do, which is marketing. These guys are a little bit different from your average marketing agency because they are very big on the technology side of things. So data collecting from customers, studying customer habits, using that analysis then to find paths into the consumer's mind to help businesses there with their creative. So creating the content, distributing the content, and then managing those campaigns from start to finish, both through digital means and traditional print as well. And they've also just acquired last year this Lasoo business, which is a really neat platform where bricks and mortar stores like Woolworths, Coles, and we'll see a bunch of them on the next page, can put the old-fashioned paper catalogues, which IVE also do, but put those catalogues into digital, and you can just scroll through them. I've used these many times. You can use them like a real paper catalogue, obviously saving the company a lot of money as well. Look, I'll let you pause on that one in the recording if you like, but it's just basically telling you what they do. I think we want to get to the nitty-gritty, which is the financials and the technicals, and these are some of the companies. So this is not a small fly-by-night business here, IVE. Their customers are the biggest and best known brands in Australia, and often you look at American Express and McDonald's, Diageo around the world as well. So the real deal in terms of their half-yearly performance, I was about to say not fantastic. In fact, you know what? It was very, very solid. Look, certainly sales revenue fell, but that is to be expected. If sales revenue falls when things are fantastic, then that's a problem. It's not a problem if it falls when the world is falling apart like it did in 2020. And certainly there were still major impacts for the local economy in the back half of 2020 through those major lockdowns we saw in Victoria. And that did lead to an equivalent fall in EBITDA. Incidentally, if you add back JobKeeper, these numbers were very, very good. In fact, EBITDA was up, net profit was up, but I don't think that's a fair way to look at the company. I prefer to back those out. So we did see a small fall there. Excluding JobKeeper, we still saw an increase in their free cash flow. There is still plenty of cash in this business, and they're using that cash to pay down debt. Dividends have been restarted. They did pause them late last year, and we're on track for 14 to 15 cents per share of dividends in this financial year. Unfortunately, they went ex-dividend, I think it was yesterday, so it's frustrating, I know, when you're looking to buy these dividend stocks and you get in the day after it goes ex-dividend, because you're then waiting 6 months for the next one, and then 12 months to get that full dividend yield that we'd like. But unfortunately, them's the breaks. I can't control when they pay their dividends. But with the company trading around about $1.40 to $1.50, that equates to a dividend yield, not on screen, it's on probably the next slide, of about 10%. We also have a share buyback in place for up to 10% of the company's shares. There's still 500 shares outstanding, and that just creates this latent demand of the system to support the share price. It's also good for shareholders long term. They have a bunch of new contract wins, including the ACM deal, $100 million deal, 5-year deal announced in the last half, and that'll start to flow through in the next half. The company, again, providing outlook and guidance, which I said before was quite unusual and fantastic, and we're forecasting EBITDA to really recover this year to about 100 million, and that compares to last year's 76.6. So we are seeing that pick up in the local recovery, economic recovery, hitting that bottom line very quickly, which is great to see. We do have a little bit of a dip coming in here due to COVID, but expectations are that those revenues and those profits are going to head back up again. We've got a fairly flat PE ratio, which is no big deal, because when it's at 8, it's that low, it really doesn't matter whether it's falling or flat, because you're really not paying a great deal for the earnings that this company has, and those earnings, substantial earnings, are starting to flow into high dividends as we go forward. There's the correct slide in here. We didn't have it on EPD, did we? Having a look at how the company ranks against the other ones, and I've just gone alphabetical here. So E becomes before I, and before we spoke about, show me one that's in the high 90s, and this one certainly is in the high 90s. The dividend yield is within the top 1% of top 500 companies on the ASX, and it certainly rates more highly, is that the right way to say it, than Empire, with an average rating of 82%, which then puts it in the top 4% of companies on the ASX. So this one is a very high quality proposition going forward. Dividend yield there is 10.3%, fully franked, and it's not one that you're getting a great yield this year and a terrible yield next year, because earnings are declining. They're not. They're on the way up as well. So you've got this potential for share price appreciation as well as great income. In terms of the technicals, as I said, we like to see short-term uptrends, which we have in place. That's very much intact. And then a long-term uptrend, which we don't actually have right now. And certainly it makes this a little bit riskier than the last one, which was in a long-term uptrend from that perspective, but not from the perspective that the uptrend is potentially going to commence very, very soon, because we have seen this significant step-up pattern here since COVID. So it's good to see this step-up pattern. It means the market is digesting what's happened. Things are getting better. Of course, there's going to be hit to this sort of company because of COVID, because of the great uncertainty. For everything, it's a marketing company, of course. But we are seeing this change in guard, and this should change soon. So I'm happy to go with the long-term trend if it is establishing, if it is in the process of establishing, and it is, and it's backed up by the short-term trend. Is it an opportune time to buy? Well, there's a pullback to that little trampoline level, but it's mainly caused by the fact it did go ex-dividend there yesterday. So it's a pullback on the chart, but it's not really a pullback when you consider that it was an ex-div. Okay, so it's actually even stronger than it looks at the end of the chart there. I haven't seen what it's doing today, but I still think this 140 to 150 level, if you can pick it up in there, I think that's good buying. Okay, the third one, dividend and growth opportunity we're going to look at today. It's not a stock, it is an ETF. And as I said at the start of the presentation, I thought I'd change it up a little by putting one in, because rather than investing in one company and taking that one company's risk, you've actually got 100 high-yielding companies in there. So their goal is about 100 at the moment. According to their data, they've got about 98. It is globally diversified. We'll have some info on that on the next slide. They are looking for dividend growth. So it's not just about having high dividend paying stock. It's again trying to find dividends that are on the rise or at least stable. And don't forget that dividends are a reflection of earnings. So we're hoping then that earnings are at least on the rise or at least stable. But you have to understand that the main focus of the stock pickers here is about income, and it's less about growth. So you're probably not going to have Tesla in this ETF, and for some people they're thinking, well, that's a good thing, I don't want Tesla anyway. It is Australian domiciled, so it's regulated over here, and you don't have to fill any of those W8s out, and that's just an admin thing, but it's nice to have. Return since inception is about 6.5%, probably compares to the S&P 500 return of probably about 7.5%. So it's a little bit behind that, but the idea is we're not about growth here, we're about income. Okay, in terms of what it's holding, you get a little piece of, ExxonMobil, for example. It's actually got a few stocks in here that are really, really doing well at the moment. So there is actually I think this is quite an opportune time to pick this up and get this recovery. So they've actually got a lot of these value stocks. We talked earlier on about this rotation between value and growth. So it's quite, I think, pertinent we're talking about this now, because we're seeing value on the way up, we're seeing growth on the way down, and these are basically all value stocks. These are all quote-unquote value stocks here, and they tend to pay higher dividends, don't they? So we've got this ability to get some exposure to this switch. In terms of what they're holding, financials, we know financials are doing very well right now. Utilities have been very depressed, but I think there's scope for those to pick up as well. Real estate should do well during an economic expansion. And then you've got the stalwarts like Staples and the rest down there. Consumer discretionary should do very well as well. What we're seeing here is a very low exposure to information technology. And for some, that might be a good thing as well. It's very much US oriented, but not overly so, with about a quarter of the index in the US. So you've got some exposure to some of those European and Asian markets as well. In terms of how it ranks versus the rest, I don't think I put the graph up here because there were too many blanks. Clearly, because it's an ETF, it doesn't have some of the metrics that a stock would have. So it's got a few, but not all of them. So I didn't put that slide up with all the blue columns. But the ones that it does have, the ones that we can compare, its PE ratio. So this is the average PE ratio of the stocks that it's holding, those 98 stocks, and it's quite low. It's definitely the value end of the spectrum. PEs of around 10, value Ps of 20 and over, growth/expensive. So we've definitely got some reasonably priced companies. Many of them have been beaten down because of COVID. At 12.6, that's within the top 20% of companies on the ASX. Its PE growth, anything less than 1 is outstanding, so that is pretty good. I'm surprised that so many companies in the All Ords have such growth, to be fair. Its price to cash flow is very good as well. Its return on equity is very reasonable, it's very solid, and its dividend yield is 5.4%, which puts it in the top 15% of companies. It's only 3% franked, as I said, because it's got all of those overseas earnings. It's not surprising. Its average rank is 73%, which gives it puts it in the top 14% of ASX companies. So certainly the fundamentals appear to check out. The timing is probably right as well with this shift back to value, and I think that's evidence on the chart as well. So we have this great basing pattern through here. It's telling you that a lot of those stocks have been consolidating after their recovery from COVID, and we've got this nice breakout through here. And if we do get them, these value stocks recovering to anywhere near their pre-COVID highs, there could be quite a bit of upside for this one as well, and you've got the benefit of that great dividend yield to back you up while you're waiting. Okay, deep breath, we're nearly there. A few honourable mentions here. So stocks that didn't make it in, not necessarily because they're not fantastic, simply because I've covered them in my webinars before, so I wanted to give you some new ideas today. But certainly IVE Risk Group, and you can go back to the webinar we did on 3 small cap stocks. This one featured in there. They do perimeter, pipeline, conveyor, monitoring, detection of faults. Again, highly exposed to that minerals and resources sector, security systems and encryption. So, for example, biometric sensors and security systems, and then transporting high-value assets around the place. Their dividend yield is quite respectable, 5.7%. It is unfranked. It's in the top 12% of companies on the ASX. Its average rank, if you put together all of its fundamental factors, is 86%, which puts it in the top 3% of ASX companies, which is outstanding. And the chart is pretty solid at the moment. A little bit frustrating for me. It's one of my favourite stocks. It's not probably getting the attention it deserves from the market. So we are in a short-term downtrend at the moment, but we are coming up against this long-term uptrend where we would expect some support to come in. Because it is in a short-term downtrend, if you're going to take that punt that the long-term trend is going to hold, it makes it a higher risk play. If you're more conservative, and there's nothing wrong with that, you might want to see a bit more demand come in and a bit more momentum, and then buy potentially through that move through 65 for what I think will be the next big up move through here. Australian vintage, I covered this also, I think, in the last webinar as well, and you can see why with a dividend yield of 8.5%, mostly franked, it puts it in the top 3% of dividend payers, and it's about 93% on the overall ranking, and vintage implies that they do stuff to do with wine. It's kind of the other treasury wine estate, but this one has the advantage of having a very small, very negligible exposure to China and the problems going on there. I could actually put Treasury Wine Estate in this list because whilst the dividend yield has come back due to their problems in China, I do expect that to return, and that's got a really interesting chart as well. So definitely look out for TWE. But this is Australian vintage, and all the boxes are checked here on the technicals. Beautiful short-term uptrend, great long-term uptrend. We've got that beautiful step pattern that we're seeing through here, and I can't see why this won't be onwards and upwards given how good those fundamentals are. And the final one I'll leave you with today is Nick Scali, also one that I have banged on about in the past. I didn't put into today's presentation. We know what they do, but with a dividend yield of 8.4% fully franked and valuation still with a PE of around about 10 and fantastic earnings growth, it's in the top 7% of companies on the ASX, and it would definitely be one I would have on my list for dividends and growth. In terms of the technicals, and maybe this is why it didn't make it into the top of the top at the moment, simply because we are in a short-term downtrend, which means if you're going to buy it here at this long-term support level, and we often see the price get near this level and then push back up again, there's a little bit more risk because you're trying to get it on that short-term downswing within this broader long-term uptrend. But I'm certainly happy on the basis of the fundamentals to back it here. I can't see there being a lot of risk if you're getting it around this level, given how strong those fundamentals are. That's it for me today. Sorry this presentation was interrupted by those technical difficulties. Thank you so much to Anthony, Lee and Hugh, who either hung around or rejoined us. I'm so sorry to those of you who left us thinking that was it. Obviously, you're catching this recording now, so hopefully all is good on that front. If you'd like to catch any of the other analysis that I provide for Think Markets, head to that market news section of the website. News, views, analysis and opinion. You can get some of that if you want to follow me on Twitter, or there's the Think Markets handle there as well. Next week I'm back with Ask the Experts. That's where you get to take control of the conversation, bring your portfolio, and I'll have a look at any of the stocks that you'd like to talk about, give you a quick fundamental as best I can. Maybe we'll look at some of those comparisons against the all ordinaries there. I've got a great spreadsheet, just type it in and all the stuff comes up, and I'll certainly look at the chart for you. So you do need to register for that one and be there at 12 o'clock on the 17th of March. Then we'll go with a bit more of a an educational one with how to create an investing plan, and then back with our usual series of stocks to watch. And I'd like to do 3 ASX turnaround stocks, which I think Treasury Wine Estate might feature prominently in that one. The disclaimer before I leave you says that everything we've discussed today is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit, so make sure you read this disclaimer carefully and understand exactly what it means, or if you're not sure, give us a call for further details. We're always here and happy to chat. Thanks for joining me today. Hopefully you got lots out of it. All the best for your trading until we catch up again. Bye-bye for now.